Welcome back to Wesley Wealth. I am your host, Wesley, and today we are kicking off a brand new, highly requested 7-part miniseries. We are going to dive deep into the hidden laws of money that the top 0.01% use to aggressively multiply their net worth. You see, you can follow all the standard money rules you were taught in school, like saving more, investing early, and working hard, and still feel like that financial scoreboard never actually moves. That is because money doesn't follow rules, it follows laws. And today, we are starting with the absolute foundation of them all, law number 1. Money loves speed, but wealth loves time. Society constantly glorifies the hustle. We are taught to move fast, close the deal, and get the quick win. Speed is simply the shortest distance between seeing an opportunity and taking action on it. And the faster you shorten that distance, the faster money moves. But you cannot confuse fast action with fast results. Fast action might generate some quick cash, but it rarely builds lasting wealth. Wealth loves time, which means making a fundamentally good decision and allowing it the long runway it needs to actually compound. Let me give you a perfect example of this from the real estate world. Imagine an investor who decides to become a house flipper. Over a 5-year period, this flipper works relentlessly. They find an off-market deal, they put their money in, they rehab the property, they sell it for a quick profit, and they move on to the next one. Over 5 years, they flip 100 different homes. They generated a lot of speed, and they made some good cash. But during that exact same 5-year period, another investor takes a totally different approach. This second investor buys one single-family property and holds it. A couple of years later, they buy a fourplex, which is a 4-unit building. They wait a little longer, pull some equity out, and buy a 20-unit complex. They never flip anything, they just hold and let the assets grow. At the end of those 5 years, the flipper has some cash from 100 transactions, but the buy-and-hold investor owns 20 units, and their overall net worth is 5 times higher than the flipper's. The flipper chased speed, but the second investor used time as their ultimate business partner. This is the exact principle that Warren Buffett proved with Berkshire Hathaway. He completely flipped the idea of chasing quick returns by simply buying high-quality companies and holding onto them forever. From 1965 to 2024, Berkshire Hathaway compounded at almost 20% annually, beating the S&P 500 by double and hitting a staggering total return of 5 million%. He understands that time is the heavy lifter in wealth creation. A lot of people hear this, and they immediately worry about when the perfect time is to jump in. They want to time the market perfectly to maximize their returns. But a recent financial study proved how dangerous that mindset is. A study tracked 3 different types of investors entering the stock market. The first investor had absolute perfect timing, buying into the market at the lowest possible points to ride the run-ups. The second investor had the worst possible timing, consistently buying right before market dips. The third investor was so terrified of bad timing that they just sat on the sidelines and held all their money in cash. Obviously, the investor with the perfect timing had the best return. But shockingly, The investor with the absolute worst timing still had the second best return. The worst returns belonged to the person who sat in cash. This proves that time in the market is vastly more important than timing the market. Every time you try to jump in and out of investments, you create financial friction. You are essentially paying tolls on the highway to compounding. Every time you move money, sell an asset, or trade a stock, you pay taxes and you pay fees. Taxes and fees are the #1 drag on wealth creation. Think of these as toll booths. Every exit and re-entry onto the highway costs you a toll, and the more tolls you pay, the less capital you have left to compound. When you change your time horizon from 5 years to holding permanently, you stop paying those tolls. So how do you actually put this law into practice? You need a framework, and I call it the rule of 3 decades. This is the exact blueprint for mastering time. Decade 1 is all about building your war chest. During this phase, your only job is to earn more money and spend less money. This creates what I call your wealth buffer. You have to separate your lifestyle expenses from your income. For example, when my wife and I first got into entrepreneurship, we made the strict decision to live entirely off of just her income. Every single dollar I made went directly into our investment machine. We maintained that exact same baseline lifestyle for 14 years, even after our income skyrocketed. Most people do the exact opposite. As soon as they earn more, they spend more. Their lifestyle expands to match their paycheck, meaning they have zero buffer and nothing left to invest. If you want proof of how powerful the war chest is, look at the story of Ronald Reed. Ronald was a janitor from Vermont who drove a used car, bought his own firewood, and clipped coupons his entire life. Yet, when he passed away, his estate was worth an unbelievable $8 million, and he didn't have a massive salary or insider knowledge. He simply bought shares of blue-chip American companies and refused to sell them. He understood that true wealth is just the gap between your income and your ego, multiplied by time. Ronald had a very small ego, so he was able to build a massive war chest in Decade 1. Once you have your war chest, you enter Decade 2 of the framework, which is to let it compound. This sounds easy, but it is actually the hardest part because you are fighting your own biology. Your brain has a fear center called the amygdala, and when it senses a threat, like a market crash, it hijacks your nervous system and forces you into a fight-or-flight response. Financial media is professionally designed to trigger this exact fear response. They use red fonts, breaking news alerts, and terrifying language to keep you watching. Making your brain feel like a market dip is a literal fire alarm. Humans also suffer from loss aversion, meaning a $10,000 loss hurts twice as much as a $10,000 gain feels good. Your brain will scream at you to sell your investments to avoid the pain. But to survive Decade 2, you have to ignore the headlines. You have to be greedy when others are fearful, just like Warren Buffett was during the 2008 financial crisis, when he invested billions into Goldman Sachs and GE while everyone else was panicking. You must let the money compound without touching it. Finally, after you have built your war chest and allowed time to compound your assets, you reach Decade 3, living off of the 4% rule. The math here is incredibly simple. You take your total annual spending and multiply it by 25. That number is your ultimate financial freedom target. Let's say you want to spend $100,000 a year to fund your dream lifestyle. You multiply 100,000 by 25, which gives you $2.5 million. Once your investment portfolio hits $2.5 million, you can theoretically withdraw 4% every single year for the rest of your life and never run out of money. Your financial freedom is dictated by just 3 things: how much you make, how much you spend, and how long you leave it alone. The longer you leave it alone, the more aggressive the compounding becomes. Stop asking what the hottest investment is right now, and start asking what is a fundamentally good investment that you can hold for the next 20 to 30 years. Stop chasing speed and start partnering with time. If you master this first law, you lay the groundwork for everything else. But knowing how to compound money is only half the battle. You also have to know how to control the board, which brings us to law number 2. He who gives the money has the power. We are going to break down exactly how buyers and builders dominate the wealth game in part 2 of this series. If you got value out of this video, hit that like button, subscribe to Wesley Wealth, and let me know in the comments below if you are currently in Decade 1, Decade 2, or Decade 3 of your wealth journey. I will see you in the next episode.